Alphabet just reported one of the strongest earnings quarters in its history. Revenue crushed expectations. Profits jumped big. Cash flow hit record highs. And yet, the stock went down. So, what scared Wall Street after such a strong quarter? One number. One massive number. $185 billion. Now, pay attention to this. Alphabet stock slipped about 2% after earnings. Not a crash. Not panic selling, but enough to make investors nervous. This was not about weak demand. This was not about slowing ads. And it definitely was not about YouTube struggling. This sell-off was about spending. Wall Street heard one thing on the earnings call and immediately focused on margins. And that thing was Alphabet's plan to nearly double AI spending. Let's get one thing straight. The earnings were actually incredible. Alphabet crossed a huge milestone. For the first time ever, the company generated over $400 billion in annual revenue. In the last quarter alone, revenue jumped nearly 20%. Earnings per share surged more than 30%. Net income exploded higher. Operating cash flow hit record levels. This was not a weak quarter. This was dominance. Search grew fast. YouTube kept printing money. Cloud went into hypergrowth. So why did the stock fall? Because the market is not worried about today. It is worried about what Google is becoming next. Here is what surprised Wall Street. Alphabet told investors it plans to spend up to $185 billion in 2026. Last year, spending was just over $100 billion. Now, it could almost double. Most of this money will go into AI servers, massive data centers, networking infrastructure, cloud compute, DeepMind, and Gemini. In simple terms, Google is going all in on AI, and Wall Street hates one thing: certainty. When spending jumps this fast, profits do not disappear, but margins get squeezed. Depreciation rises. Free cash flow looks messy in the short term. Alphabet even warned that depreciation costs will rise sharply in 2026. That is why short-term traders sold. They sold first and asked questions later. But here is the key detail. This spending is not defensive. It is aggressive. This surprised Wall Street. AI is already paying off. Search is changing fast. People ask longer questions, more conversational questions, more visual searches. In the United States, daily AI-powered searches per user have doubled. And Google is quietly testing something huge: ads inside AI answers. Imagine asking Google a question. You get an AI response. And right below it, shopping offers appear. That is not just search. That is commerce. That could become Google's next major ad engine. Now let's talk about the real sleeper, Google Cloud. Revenue surged nearly 50%. Operating profit more than doubled. But here is the number that matters most: $240 billion. That is the cloud backlog. That is future revenue already signed. Companies are locking in Gemini. Enterprises are choosing Google for AI workloads. Even Apple is partnering with Alphabet for next-generation AI infrastructure. This is not hype. This is demand. There was one thing that hurt sentiment. Alphabet took a multi-billion-dollar compensation charge tied to Waymo. That pushed R&D expenses higher. But here is the irony. That charge happened because Waymo's valuation increased. Waymo is now completing hundreds of thousands of autonomous rides every week. It is expanding into new cities. It is becoming one of the most valuable self-driving assets in the world. Short-term pain, long-term optionality. Zoom out for a moment. This was not just about Google. The entire tech sector was under pressure. Investors rotated out of high-growth stocks. Risk-off mode kicked in. Alphabet did not fall because it failed. It fell because expectations shifted. Now here is what could happen next. If Alphabet executes, if AI adds scale, if cloud backlog converts into revenue, if margins stabilize after the spending wave, then this pullback could look like noise. But if AI spending keeps rising faster than revenue, margins could stay under pressure longer. Alphabet is no longer just a safe tech giant. It is becoming an AI infrastructure powerhouse. And that brings volatility. So here is the real question. Is Alphabet burning cash, or is it building the most powerful AI platform on Earth? Because the market is clearly divided. Long-term investors see opportunity. Short-term traders see risk. Now, I want to hear from you. Do you think Alphabet's massive AI spending will pay off, or will it hurt the stock in the near term? Drop your answer in the comments. And if you want more earnings breakdowns like this, like the video, subscribe, because this AI arms race is just getting started.